We have touched on many central bank actions: setting rates, managing money, easing in crises. The umbrella term for all of this is monetary policy. Pulling it together clarifies what central banks are really doing when they act. Monetary policy is the collection of actions a central bank takes to influence the overall economy, primarily by controlling interest rates and affecting the supply of money and credit. Through these levers, the central bank tries to steer the level of economic activity and, above all, to manage inflation. It is how a central bank puts its goals into practice. Monetary policy broadly comes in two directions. Loosening, or expansionary policy, means making money cheaper and more available, typically by cutting interest rates or adding money to the system to encourage borrowing, spending, and investment. This is used to stimulate a weak economy or lift too low inflation. Tightening, or contractionary policy, means the opposite, raising rates or reducing the flow of money to cool an overheating economy and bring down high inflation. The central bank's job is to judge which direction the economy needs and by how much. It weighs inflation against growth and employment, adjusting policy to keep the economy on an even keel. For example, judging that inflation is too high, a central bank tightens monetary policy by raising rates. Later, facing a slowdown, it loosens by cutting them, steering the economy through its main tools. Central bank mandates, tools, and targets vary from one country to another, and they change with economic conditions. Even economists disagree about how policy and money creation really work, so check which institution sets the rules where you live. The main lesson is simple. Monetary policy is the set of actions a central bank takes, mainly through interest rates and the money supply, to influence the economy, aiming to keep inflation stable and support growth and employment.